Welcome, everyone. Dr. Fasanya. I'm the CEO for Dr. BDZ Capital. And welcome to another episode of our webinar. We do this every 2 weeks, trying to educate the medical community. My co-host is Dr. Ozoude. He's at the airport right now. He's off camera, but he's participating along with us. We have a special guest today, Taiwo. And Taiwo is a friend of mine, and we met over a year ago. And she's been helping me with tax planning, mostly, and alongside with my CPA. I'm just going to make a quick introduction. Taiwo is a Texas and Indiana certified public accountant. She earns her BSc in accounting from Oxford Brookes University in United Kingdom. She graduated from Indiana University, Purdue University, Indianapolis, Indiana in 2012 to earn a master's in economics. She has over 10 years, probably more now, of combined work experience in accounting, financing, and taxes, including experience at a Fortune 200 company. Her experience at a public accounting firm gave her the privilege of serving small businesses and individuals. And now she's been serving many of our investor communities because she herself is interested in real estate, oil and gas, and different kind of asset classes. So when you have an investor who is also a CPA, so that's helps a lot because they understand what you're going through, and they themselves are looking for ways, right, to reduce the tax burden. So as an accountant, she prepared individual taxes, business taxes, financial statement preparation, and payroll tax reporting. Our goal is to help individuals grow their businesses. So I've been doing a lot of one-on-one recently with investors, and towards the end of the year, the most commonly asked question is who is your tax planner? How do I reduce my taxes? Do you have any opportunity to help me reduce my taxes? So we're going to be doing this every year towards the end of the year for us to prepare for the next year, right? Without further ado, I'm going to let Taiwo take it over.
Dr. Fasanya has done a good introduction. Thank you, everyone. Good afternoon, good evening, wherever you're joining us from. Before I begin, I'd like to quickly do a shout out to Dr. Fasanya and Dr. George Ozoude. These are phenomenal, fantastic individuals that I've been privileged to know and be connected to. And so I'm really happy to be a part of their community and to be presenting this tax webinar today. For those of you that do not know me, my name is Taiwo Agbaje. I'm a CPA licensed in Texas and Indiana. I'm also a real estate investor, and I am an entrepreneur as well. I've worked with in a Fortune 200 company. I've had over 15 years of experience working as an accountant from Africa and then in the United States as well. I currently run an accounting firm located in Austin, Texas, and we help real estate investors, business owners, and high-net-worth individuals to help them save on taxes. I'm married with 3 kids, and yeah, so let's dive right into the webinar. Before I begin, I would like to quickly do a disclaimer. This webinar is for educational purposes only. We do not intend to provide tax advice, and so please do not take anything I'm going to say as a tax advice that you go implement without consulting a professional. If you have an accountant that you're currently using, it's going to help you spur conversations towards the right approach on your taxes. If you do not have a tax planner or a tax professional, definitely we are able and happy to help you. But again, this is not a tax advice. So before I begin, I always like to bring people back to the most important part of the taxes, which is the marginal tax rate. The marginal tax rate it shows the impact of an extra expense that you spend on your taxes. If you are looking at this screen right now, I know that we do have a lot of high net worth individuals, real estate individuals on this call. And so a lot of you are high income earners. most of you will probably be at the 32% tax bracket or maybe 37% tax bracket, whatever that case may be for you. But what I want you to know is that even though this is the tax bracket, it doesn't mean that you're paying 37% in taxes. What it means is that you're paying the first 10% of your income is taxed at this rate, and then the next is taxed at 12%. But if you are on this call and your income is in excess of any of these numbers here, what this means is that all those excesses are taxed at 37%. And so this brings me back to the basics that a lot of taxpayers, this is where I always start from, is do you understand where your tax bracket falls into? Because that would help you understand the impact of whatever tax policies you're doing. It helps to understand whether you're spending, each dollar you're spending, what impact is that going to have on your taxes? And it's not only federal taxes. When you look at the way we are taxed, a lot of us are located in states that are also, that have income taxes, state income taxes. And so what does this mean for you as an individual? If you are located in states like California, DC, Hawaii, New Jersey, or New York, your state marginal tax rate is even high. Those are the states that have the highest marginal tax rate. So alongside the federal taxes, you are also facing the state income taxes. And so as an individual, high income earner, you are probably going to be faced with paying about 40% to 50% of your income in taxes, right? And so that is the reason why we are here. You don't want to just sit down and sit back and just wait till April 15 or April, whatever that is, to file your taxes and realize that, oh, you owe $500,000 in taxes or you owe $1 million in taxes. Because at that time, it's often too late for you to do anything. And for those that are in non-income state taxes, Alaska, Florida, you may not have to deal with the state income taxes. But I know that a lot of people are located in states that have state income taxes. And so you also have to factor that into your tax exposure. As in addition to those state income taxes, we also face property taxes. We do pay sales taxes. We do pay all other taxes combined together. And so that is why taxes is a very critical aspect of your finance as an individual. You just cannot ignore it. If you do that, you're doing that at the detriment, because at the end of the day, it's going to seem like you're just working for the government. But again, the government isn't bad at all, because they've also given us avenues for us to really legally, within the confines of the law, they've helped us to realize that there are strategies that we could take to cause as individuals to save on taxes. But those strategies aren't for everyone. They are available there in the tax code. But a lot of us are not, a lot of taxpayers are not proactive enough to understand which of these policies, which of these strategies they could utilize for their own benefit. And so that brings me to this comment. I always refer to this because I know that we have different folks on this call right now, but it's also important for us to understand that as an individual taxpayer, you have to understand where you fall into within the economic cycle. And this is a quadrant from Robert Kiyosaki. A lot of us are familiar with this. I've spoken with, when people consult with me, real estate investors especially, one thing I always hear from them is that the first thing that introduced me to real estate is Robert Kiyosaki, right? So the cash flow quadrant. So this is why I needed to bring this here, because when you look at this, we have 4 quadrants. Where do you fall into? We have the employee, the business owner, the self-employed, and the investor. I always want to look at it from the right side and the left side. The right side is the employee, meaning that you're trading time for money. And then also, it's also the self-employed. The self-employed employed individuals are also on the right side of the quadrant. These individuals are safe at their trading time for money, and they're also paying a lot in taxes, particularly when it comes to taxes. So I'm trying to explain this and relate it to taxes as a whole. And then, so when you look at the right side, those are the business owners who have employees that are working for them. They're buying back their time by having people working for them, and so they are able to live a more life of freedom, financial freedom, and flexibility. Then we also have the investors, who are really passive investors that earn money even in their sleep. And so that is why when you look at this quadrant, where you always want to be, where you want to find yourself is on the left side, is on the right side, sorry. Maybe from my own side of the screen. You want to be on the business owner and investor side, because that is where the key tax savings, tax incentives are for individuals. So when we talk about the whole thing, taxes, and going from the previous slide, I mentioned that you have to be a business owner or you have to be an investor. one of the things you have to realize is that the government role in the economy is also to help us. The fiscal policy of the government is very important. And taxation is one of the most important fiscal policy of the government. And so what government uses taxes to do is to stimulate spending in the economy, to help us to understand, to also help provide more incentives to people that have invested in those sectors that they really want us to be invested in. And so we know that the government is there, but the private sector is also there doing their own thing. How does the government come into play here? And that is the fact that because the government handles the taxes through the Congress and executive arm of the government, they've been able to create incentives for individuals from the private sector that are ready to invest in those sectors of the economy that the government cannot fully handle. We all know that the government cannot create jobs for everyone in the country. And so they're looking for business owners that are really ready to do that. So if you're an entrepreneur and you're creating jobs for folks within the country, you're creating jobs, whether it's a small business job, whatever that is for you, you're going to get incentives for that because you're helping government. And so there are a lot of incentives in the tax code to help business owners to really encourage them to go into business so they can create more jobs and help the economy. The same goes for real estate investors. There are a lot of housing problems when you go to states like California and New York. Government isn't able to do everything. They aren't able to provide housing for everyone. So they're looking for, again, private sectors and organizations that are really, they have the cash flow that can really invest and provide some of these assets and these amenities for the economy. And so again, huge tax savings for real estate investors as well. The same thing goes for oil and gas and solar, renewable energy security and all of that. Those are very important things that the government is highly invested and interested in. But again, they cannot do everything themselves. And for individuals, for you and I, where are we putting our money as individuals? Where do we think that even though we are spending this money, even though we do want to get tax savings, you have to really think about where you're putting your money, because you don't want to just spend money for the sake of tax savings, for the sake of we don't want to pay taxes. You don't want to do that. You also want to make sure that where you're putting your money is in the sectors that will really give you some returns back. Yes, you may be getting tax refund or whatever, tax write-off, but are those cash flows that are going on, are they also bringing some kind of return for you? And that is why you really have to be thinking about the allocation, how you're allocating your fund, especially for high income earners that are really making a lot of money, have rich cash flows, and are thinking about, where do I invest my fund? How do I do this so that I can save on taxes and I can also have some investment? So that's where you want to go on this. And that's why I really wanted to share this screen. But now let's go right into the taxes now. Let me know if I'm going too fast. I have very limited time, so I'm trying to just capture as much as I can. We really cannot talk about tax planning also without mentioning these differences between deductions and credits. The reason why I needed to bring this here is because I've gotten a lot of questions where even when people are consulting with me, they will tell me, hey, Taiwo, if I put $20,000 in this investment, or am I going to get $20,000 back? Right? That is not how it works. So deductions are expenses that the government has allowed you to take to offset or to reduce your taxable income. And so the effect of deductions on your taxes is not a dollar for dollar deduction. It is a percentage of your marginal tax rate. I talked about marginal tax rate in the prior slides. And so when you're thinking of, okay, if I'm spending $100,000 right now, how much will I save on taxes? If you are at the highest tax bracket, that's an easy calculation for you. The marginal tax rate times whatever you're spending, that is the savings you're going to get on taxes, right? So when you compare that to credits, on the other hand, credits are dollar for dollars, meaning that if you were able to get a $2,000 credit, you're going to save your taxes $2,000. It's a dollar for dollar savings. So fortunately, credits are very limited. It's not you can't really get. I don't think you can get a credit of 100,000, or credits are very, very limited. They aren't as available to everyone as deductions, and that's because oftentimes they have limitations, income limitations. But again, credits, the difference between that is that credits gives you a $1 for dollar savings, while deductions give you a percentage of your marginal tax rate. And I know that a lot of people that are here are real estate investors, no doubt about that. And so we're going to start with real estate investment as it relates to tax planning, tax savings. So when you get it to that point where taxes becomes a burden, If you've moved from maybe earning $100,000, $200,000, and now you begin to earn 400,000, 500,000 and above, you realize that the huge shock you're going to get is just the taxes that you're paying. You will see that number and you almost cry like, what is this? And so you have to realize that the very first investment that people think of is real estate. And I don't blame them, because even with history, their books, their history have been made with folks that have been millionaires using real estate. And so that's usually the very first avenue for people to invest in and put their money in. But there are a lot of rules that is surrounded by real estate investment that, in my experience working with taxpayers, I've realized that a lot of people are still not versed in that regard. And either they are not well informed, or their tax preparer is not even well informed, or they aren't even ready to do the right thing. And that's why it's important for me to always also talk on the passive activity rule. Sorry, there's a mistake on the spelling there, but so the passive activity. So as you all know, real estate investment is a passive activity, which is that you're earning money without exerting any effort. In your sleep, you're making money. So according to the law, I've studied the IRS code, that IRS 469 is the code that pertains to passive activity. What the law says is that for passive activity, you can only offset passive losses against passive gain. So if you have income from your real estate and you also have losses from your real estate, you are only able to offset you're able to offset your losses from your real estate with passive income. What does that mean? A lot of us that are in real estate have W-2 employees. We are business owners. So we have active, we call it non-passive. We have non-passive income. So oftentimes people think that, okay, let me go buy that property. If I make losses on my property, I will do cost segregation, and that loss I can use it to offset my W-2 income. That is not how it works. Because your W-2 income is a non-passive income. And so you cannot offset your income with losses from your real estate because of that passive loss limitation. But there are three key loopholes or three key exceptions to that, which is number one, the passive activity loss allowance. There's a $25,000 that is allowed for individuals that are W-2 employees or business owners that are actively participating in real estate. But even though you have access to this $25,000, there is an income limitation. If your income is above $150,000, you don't get to have that allowance. And I know that a lot of people on this call have incomes that way exceeds $150,000. So essentially, you are not in that realm of folks that can really take advantage of that, except you're really doing tax planning to the point that you're able to bring your income, your adjusted gross income to a level that is going to bring you down to this income bracket. So let's say you have $300,000 in income or 250, and you've done different tax planning strategies, invested in different things, and at the end of the day, you and your accountant, your CPA have come to the realization that you could put you could implement strategies that will put your modified adjusted gross income to this level. You may be able to take that. Again, it's going to require planning. But if you sit down and not do anything, just from your W-2 income, if you exceed this level, this range, you cannot take advantage of this $25,000 passive activity allowance loss. Now, the next thing is the real estate professional status. I'm going to talk on that on the next slide in the interest of time. Then the short-term rental loopholes as well. I have a screen for that as well. So these are the three exceptions whereby you can use your passive losses from real estate to offset your W-2 income or your business income or your non-passive income. Now, qualifying for reps. This is the gold mine of real estate. For those that are reps that have qualified for this, they are making very good use of real estate. They are using the loopholes to the maximum advantage. And it's also very difficult to reach. It has a very high burden to meet. And so what does it mean to be a real estate professional? It means that you have to have at least spent 750 hours in real estate trade or business in which you materially participate. Material participation is very key. Oftentimes, people just talk about the 750 hours. They don't talk about the material participation, right? The 750 hours, yes, it helps you get to it's one of the qualifications. But even more importantly is also the material participation, and I'm going to touch on that a little bit. Also, the second rule is that you also have to have spent 50% or more on real property, trade, or business other than any other business. So let's say you have a W-2 income, right? And you're claiming that you spent more than 50%. What that means is that if you spend 2,000 hours on your W-2 or regular income, you would have to spend about 2,001 or 2,002 hours on your real estate. So you have to be spending more hours on real estate than any other business that you have. And a lot of real W-2 employees find it very hard to accept this. They always want to qualify for that reps. By all means, yes, I do qualify. Ignoring that the rules are very strict. And even though you may be preparing your taxes, ignoring or flaunting this rule, it's always the problem and the risk there is that in the event of an audit, often, almost all of the time, it's going to be very hard to win in an audit or even in the tax court when you have a W-2 employment and you're also claiming rep status. It is very hard, right? So the material participation, there are also other requirements for that, but I didn't list those out here just in the interest of it's quite long. But material participation essentially means that you also have to, for each of your property, aside from meeting the 750 hours, for each of your property, you have to materially participate. Meaning that you have to, number one, either there are about 8 conditions, but you just have to meet one of them. It's either that you're essentially the only person doing all of the work in the property, and one property is one activity. So if you have 10 properties, you have to materially participate in each of those 10 activities to the extent that you're also meeting the 750 hours. In the interest of time, I can't really go into deep details of everything, but I know a lot of you that are here understand where I'm coming from. But if this is also new to you and you're just about getting and starting your real estate journey, I really encourage you to go read this rule. I've stated the code in the power slide. Go and read and understand your eligibility and your deductibility for real estate losses on your personal income, on your W-2 income, so that when it's time for you to file taxes, you're not surprised that, oh, you aren't able to use those losses, right? So the more you get informed, the better for you. And another thing I also have to state is that for those that have spouse, if you're a medical doctor, whatever business you're in, and your spouse is a stay-at-home mom, or she's not working, whether it's the guy or it's the female, it's easier for that spouse to qualify as a reps than when both husband and wife are working. So what people are doing is also, okay, if the spouse is not working, how do we make the spouse qualify for reps? And as long as you're filing your taxes as a married filing joint, you both qualify as a reps. So let's say Mr. A is a physician and Mr. A's wife is not married. If Mr. A's wife qualifies as a reps, Mr. A can also use the rep status on their tax return as long as they are filing a marriage filing joint tax return. So that's a strategy for you there that I just mentioned now. So for those that have wives that are not doing anything and you're actively involved in real estate, this is something you could consider as well. But again, don't forget that the reps is the all and mighty of real estate. If you are there, I'm sure you're already taking real advantage of that. But if you're not there, it's okay. The problem, the thing you have to realize is that even though you don't make use of those losses, the losses that you are not making use of are not lost. So if you find yourself in real estate, you have properties and you have losses that has been suspended, you're still going to use that loss when, number one, you qualify for real estate professional status. If at any time you do qualify, those losses will be released. Or secondly, when you dispose of those assets, all those losses will be released to offset your capital gain. And so at the end of the day, essentially, it's either you're taking the benefit now, or if it's suspended in the future, you're still going to make use of those losses. So real estate is always a good investment. You really can't go wrong with those strategies with investing in real estate. So the first thing I want to talk about as far as the strategies is cost segregation. I'm going to move fast in the interest of time. So cost segregation is really done so that we can make use of bonus depreciation. Bonus depreciation is an accelerated depreciation that allows you to take depreciation in the first year of purchase of an asset that has been placed in service for that year. And last year it was 100%, this year it's 80%, and next year is going to be 60%. So for those of you that have assets or properties that you've placed in service, maybe last year, and you didn't do cost segregation, you still can do cost segregation on those assets as long as, number one, they were put in service last year. And then also, you also have to factor in the fact that before you do cost segregation, for some of the things that we always ask our clients is to ask them how long they intend to keep the property. If the property is planned to be kept for maybe 2-5 years, cost seg might not be a good strategy, might not really help much. But if you intend that you're going to keep an asset for a longer time, cost segregation is really a good strategy to consider. What it does is that it breaks a property into the 5, 7, 15, and 27.5 years or 39 years for commercial properties. And so for assets that are between 5 and 15 years, you are able to take 100% bonus depreciation. That was for last year, it was 100%. For this year, it's going to be 80%. And so you find out that at the end of the day, when you do a cost segregation, you could get as high as $100,000 write-off. 100K write-off, depending on the value of the property, depending on everything that comes out from that study, you could actually be saving yourself 6 and multiple 6 figures in taxes just by using cost segregation. But you also have to understand that with cost segregation, there is depreciation recapture, right? Now, what that means is that when you sell that property, you're going to eventually pay taxes. And depreciation recapture is taxed at ordinary income tax rate, which is usually higher than capital gains tax rate for high income earners. And even though you're doing cost segregation, just know that when you sell that property, the depreciation recapture is going to be there. But again, when you think about the savings it gives you, let's say you do a cost segregation and you're able to save your taxes instead of writing $100,000 to Uncle Sam, you're able to recoup that money, and through cost segregation, you're able to save yourself $100,000. Think about what $100,000 can do for you now. Could it help you invest in another property? Could you invest in other deals? So when you think about the time value of money, you realize that it is still a good strategy. Another thing you have to consider is that when you purchase a property, you and I know that the furniture in the house, some of the assets in that house are not going to be a 27.5 years of assets. So some of the things I'm talking about is maybe your furnace, your what's called the electrical parts in the house and all of those things, your kitchen equipment and all those things. Those things are usually 5 or 7 years. So it's really, even when you think about it from the time value of money and even from accounting perspective, you realize that for some of those assets, it doesn't make sense for you to even spread those depreciation for 27.5 years. Why would you want to depreciate your fridge for 27.5 years when in actual fact fridges are depreciated for 7 years or 5 years? So even cost, when you think about it from that perspective, cost segregation is still a very good strategy that every real estate investor should be looking into, regardless of whether it's a long term or short term, right? Then the next thing is short-term rentals. Now, this one is the loophole. A lot of people are going into short-term rentals, and that's because if you do not qualify as a rep, this is the other alternative that you have. But again, with taxes, everything has rules and laws. But the key thing I'm going to touch on is the fact that for short-term rentals, you have to stay. The average stay has to be 7 days or less. So meaning that for those that your guests, the guests that sign up for your apartment or for your property, they have to stay there in 7 days or less. If that 7 days or less is exceeded, you're gonna flounce. You may not qualify for the short-term rental. So you have to make sure that rule is really abide with. Then the other one is material participation. Again, you still have to materially participate. What does that mean? That means that for that property, you still have to be very involved. If you are using a property management company, there's a high likelihood that you're not materially participating. So if you want to do short-term rentals, you have to be the one doing almost all the things like the booking, the calls, and all that. Material participation is key. And then also the last one is substantial services, which is where I've seen that a lot of people get this one all messed up and incorrect. So the material participation, the substantial services is that you have to run it like you're running like an hotel. So it's not just enough for you to do 7 days and material participation, but what services are you providing for your guests in addition to them being your guest? So think about an hotel. When you go to an hotel, what are the services that they will provide for you? Oftentimes, they're going to be folks coming in, changing your linens. They're going to be provided with meals and entertainment, daily cleaning. And when daily cleaning, it has to be cleaning within while the guest is still there, not in between guests. So someone is there for 7 days. You have to have someone that will go in and knock and say, hey, room service or something like that. They'll go in, clean it for the day, or maybe every other day. So I'm not talking about cleaning where someone stays for 7 days, they leave, and someone else comes in, and then you clean in between. That is very synonymous to where a long-term rental, usually for long-term rentals, obviously, when you have someone that stays in your property for 3 years and they're moving out, you usually clean it up before the next tenant comes in. So we are talking about cleaning while the guests are still in your property. Then another thing is conducting outings and guest tours, providing transportation. So those are the substantial services. If you are able to meet all of these requirements here, then you can take advantage of the real estate activity, the passive activity loss limitation. You are not going to be limited as to the use of your losses from your real estate. So when you have a short-term rental and you qualify for these rules, what that means is that you can use losses from that property to offset your W-2 income. And again, you have to understand that now your taxes will have to be prepared on the Schedule C. And there's some Schedule C, when you prepare your taxes on the Schedule C, self-employment income kicks in. So that's just another thing to realize, that when you have a short-term rentals, you might be looking at Schedule E, you might be looking for Schedule E on your tax return. But if you really do meet all of these conditions, like these 3 conditions, your taxes will now be filed on the Schedule C, because now you are running it more an hotel-like business entity. So that's that for short-term rentals. Then the next one is 1031 exchange. A lot of you may be familiar with this one. This is where you're swapping one investment property for another to defer capital gains tax. So instead of you paying capital gain tax on a property that you sell, you decide that, oh, you don't want to pay capital gains tax. So what you're going to do is you're going to buy a similar property within the same, there are conditions that are tied to it. But what it is that you're going to buy a replacement property that is similar to the one that you disposed of. And the conditions are there, that I've written a few conditions here. You have to have a qualified intermediary. The funds must be kept in an escrow. And there's also a 45-day rule and a 180-day rule. The 45-day rule is that you have 45 days after relinquishing the other property to identify a new property. And then you have 180 days to close on the new property for it to really qualify for 1031 exchange. There are folks that are out there that are very experienced in this. If you want to do a 1031 exchange, please, I really recommend that you look for a qualified intermediary and folks that are really very vast in this, because oftentimes I've seen situations where people try to do, a taxpayer may try to do it, and they may have, really one way or the other not met that condition because of either they didn't do it well or something just went wrong. But you really have to use someone that is a company that is really very vast in it, in 1031 exchange. So now moving out of real estate, I want to go into the non-real estate strategies. When we talk about tax plan itself, we are not just talking about real estate. We are also talking about what other investments are there. Where can I put my money? That even though I'm saving on taxes, I know this money might still come back to me either as a return on investment or even as a return on capital, on equity. And so one of the strategies that the rich utilize is that even though they are saving on taxes, they're also putting their monies where they can get some kind of return back. And aside from real estate, which the economy is with high interest rate right now, it's not even very attractive now. But what alternative sources of investment are out there? What are people doing to also invest and save on taxes? So the first one I'm going to go into is oil and gas. Oil and gas is very risky. I have to say that. That's the first thing I need to say. But it is one of those strategies that has the highest tax write back. If you invest $100,000 in an oil and gas deal, there are folks that are really very vast in the operations and all that. But if you invest in an oil and gas deal, you could get as high as 80% of that as right back. So meaning that if you invest $100,000, you could get a tax write-off of $80,000 or even more. And that's because for oil and gas, the tangible drilling and intangible drilling costs are eligible deductions for taxes. And most of the oil and gas deals most of their expenses are within this bucket, the drilling cost. And so that's why it's risky, but the savings is even better than real estate investment when you look at the deductions that you can get. Another thing you have to understand with oil and gas is that for you to invest in that deal, you have to be an accredited investor. For you to be, so a lot of you folks right here, you probably are going to qualify for that accredited investor. And then also it has a minimum investment. Most companies that do this have about $50,000 or even $25,000. I've seen a company that does $25,000 as minimum investment. So if you want to invest in oil and gas, a lot of companies require at least 50%. But recently, one of my colleagues, CPA colleagues, told me about a company that accepted $25,000 investment in oil and gas. And at the end of the year, you're going to receive a K1 for your taxes. But again, this is because of the risk. You have to really do your due diligence as well before you get into that. Then the other one is solar panel projects. Solar panel, even a lot of individuals are already putting this on their properties. So the tax benefit of solar panel is a credit. So you get about 30% credit back on your investment, whether it's a residential or commercial solar. And for the residential, it is non-refundable. So a lot of people may have this solar panel vendors may have been approaching you to do solar panel and all that. One thing that we've realized as in the group of CPAs that I'm in is that a lot of them are saying that if you go ahead to invest in solar panel, the credit is refundable. It is not refundable. Non-refundable means that if you don't have a tax deal, a tax owed, that credit is going to be useless and you can't use it any longer. So before you invest in solar panel, again, you have to speak with your tax professional. Very important. I've seen people do this mistake a lot. Please, before you invest in anything, if you have a tax, you should have, if you are here, if you don't have a tax, a CPA that you can send a message to and say, hey, I have this thing, what do you think about this? You are actually losing more than you think that you're gaining, quite frankly. Because you should have someone that can really say, oh, someone sent me this, what do you think about this? Can I get this tax savings? Because last year, I remember that I handled a solar panel for a guy that they told him was going to get about 30% back. Yes, that's true. But that guy he couldn't use all those credit because his tax deal was low. And as a result, he lost a lot of money just by that. And so that is why when you're taking actually investment in very huge dollar amount, you really have to also let your CPA or whoever is working on your taxes to know whether you qualify based on limitation, and then whether those credits are fundable or not refundable, so that you don't lose out on them eventually. Okay. Then the next one is entity structuring. Before I go into entity structuring, I want to touch on a question that almost everyone, it's out there. And that is, Taiwo, I want to create my entity in Wyoming or in Delaware because I don't want to pay taxes. So I'm going to go create my entity in Wyoming. But I'm going to be buying assets and properties in California, in New York, in all those states. And because I'm in Wyoming, I'm expecting that I'm not going to pay taxes on whatever income I've made. So this is a very big mistake that I've seen people make. When you set up an entity in a state that you don't reside in, for instance, Wyoming and the likes of those states, it doesn't absolve you from paying taxes in your state if you generate income in that state. So in simple terms, your taxes is based on nexus. Nexus is where are you generating that income? If you create an entity in Wyoming, Delaware, and you have a property in California, California will still tax you on your income because you're generating that income in California. If you have a property in New York, it will still tax you because that property is in New York. So before you open and add more work to your compliance work, make sure that, number one, the property that you're buying or where you're buying that property is in a non-income state tax. So states like, right. So don't open an entity because you're trying to avoid taxes and open an entity in Wyoming and then you have properties in California. I'm actually dealing with one case right now, a new client, and I was like, you just created more work for yourself. You're in California, you ended up opening an entity in Wyoming. So we are dealing with Wyoming, we are dealing with California. California will collect every penny from you. Their tax will not go, they will not let you go without paying their taxes. So before you even do that, again, consult with a CPA, consult with a lawyer when it comes to entity structuring. And the CPA perspective is from the tax perspective, not from legal perspective. So most CPAs they'll give you advices based on the tax implication, but not on the legal implication. So when you're looking at the legality and liability, you have to also be working with a lawyer as well. But the key things I wanted to know with entity structuring is that if you have a well-structured entity, you also tend to save a lot in taxes depending on how your entity is structured, right? For instance, S-corps reduce self-employment taxes. If you have not a real estate right now, if you have another business and you're making more than $100,000 net profit, not gross, not revenue, net profit, you can explore the benefit of S-corp because you're going to be saving about 15.3% in self-employment taxes. That alone can save you thousands and thousands in taxes. Now, I also have to mention that please do not put real estate in S-corps, please and please. Real estate don't belong to S-corp. If you want to structure your real estate into an entity, LLCs or multi-member LLCs is the way to go. Don't put it in an S-corp, okay? Then the last one is what I mentioned about the nexus. And then also, when it comes to entity structure, we know that you don't have to overcomplicate things. It doesn't have to be complex, right? Think about what your goals are, discuss that with your CPA, your lawyer, and think about what your goals are, and then they'll be able to help you come up with a structure that is tax efficient and also protects you legally and is also aligned with your whether current goal, short-term goal, and long-term goal as well. So that's entity structuring, very good strategy. Last year, we were able to do an entity structuring for a client where we created a C Corp. We did an entity because C Corp right now is 21%. So when you're looking at C Corps and whether you're a partnership or self-employment, for individual taxes, for those of you that are here, your taxes is probably maybe 37% and all that. But C Corp has a flat rate of 21%. So for individuals that are being taxed at 40% for the 5%, if you have a C, your taxes you're taxed at 21%. But C Corp also has the double taxation issue. So you also have, again, you have to sit with someone that will sit down with you and say, okay, we understand that C Corp is 21%. Are we also factoring the fact that your distribution is 15%, is taxed at 15%? So all those things are really, they have to be looked holistically. You can't just look at it in silos. You have to look at everything to determine the best structure for your entity. Again, that's why sitting down with your CPA or your accountant is still the best decision that you can make when it comes to your business and your real estate investment or whatever you have going on. And then hiring kids. If you have children and you know that you, one way or the other, they helped you in the business, whether it's real estate, whatever that is, whatever business you're running, have you looked into putting them on payroll? Again, this doesn't mean that you're just going to put them on payroll without giving them anything. There has to be a contract written. There have to be time logs. There have to be documentation and contracts to show that they're actually doing this work. And then you can pay them up to this amount that is not taxed at the federal level. State taxes may still apply, but if you pay them up to this amount, which is the standard deduction amount, imagine if you have 3 kids and they are at the age that you can employ them. That's about almost $50,000 there. And if you are at the 37% tax bracket, that means that you'll be saving yourself 37% times that amount. So again, worth looking into. If you have kids that you feel like they could be of benefit for you in the business, a lot of people are using this strategy. You can also implement that as a strategy for yourself as well. But consider the state labor laws, and there are also specific rules that apply. This strategy is also something you have to consult before you do that as well. Donation-based strategy. This one is if you are going to itemize, if you know that you itemize your deduction, look into how you can factor in some kind of donation into your tax strategy. If you are highly charitable, one of the things that you could do is donor advice fund. Donor advice fund is where you create a fund with Fidelity, Vanguard. They have this account where you could put in money there. You don't have to donate that money now. So the way it works is that you create an account on those brokerage accounts, and then that account, you're getting a tax write-off the year that you make the donation. You don't have to distribute that money that year. So let's say I want to donate $100,000 next year or in 5 years. Because I have a high tax exposure this year, I might decide to put $100,000 in a DAF, right? If I do that, I get that tax write-off now this year, and it can substantially reduce my taxes. But there is a limitation, which is 30% of your AGI. Another one is leverage donation strategy. I'm not very fast on that, but I do have a third party that really does very good strategy on this one. Then donating appreciated property. If you have property that are appreciated, and instead of you selling those property, you could donate appreciated properties, because again, appreciated properties, when you're donating those, you're getting out the tax write-off. And then the key thing is that it avoids capital gains, right? If you're donating appreciated properties to 501c organizations, you're also circumventing and preventing capital gains on that property. Cash donation and non-cash donation. A lot of us overlook non-cash donation. If you look at your house right now, what are the things that you can donate to goodwill, Salvation Army, right? Those things could add up, particularly, again, if you are itemizing and if your tax bracket is high. If you are at the 37% tax bracket, then a $10,000 worth of donation is going to save you $3,700 because your tax bracket is high. So don't sit and look and say, oh, this is not going to move the needle, it's not going to move the needle. Your tax rates will determine how much impact it has. Again, worth looking into as a strategy. And this particular one is for those that are in states that have state income taxes. So states that have income taxes, California, New York, and all of those states. Now, the PTET is pass-through entity taxes. If you are in any of those states that has state income taxes, please go and check your state income tax website and see if they have a PTET rule, right? So what this does is that for the state and local taxes, there is a limitation of $10,000. This started when Donald Trump, the Tax Cut and Jobs Act, right? So there was a limitation of 10,000 on. So that means that what this cost was that for folks that are in states that have high property taxes, if you have a property tax of about $30,000, the maximum you can take in a year is 10,000. So this is even still an issue right now, because imagine states that have high property taxes where in the past they used to be able to use those property taxes as a tax write-off significantly. If you're in California, if you're in, for instance, in Texas, you can use your taxes to write off your state income taxes to write off to reduce your federal tax owed. But Donald Trump came, and that law came with there was a rule that the maximum you can take for state and local taxes is $10,000. So what these other states did was that, okay, for individuals that have S corps and partnerships, what they're allowing us to do is that now the entity can pay your taxes. So if you have a partnership business or an S corp business, rather than the partners paying the taxes, the entity is going to pay the taxes at the entity level, and then that's going to be a tax write-off for the business. It's going to reduce the taxable income for the business, and the partners will get a credit for that. It's a little bit complicated, not straight. But again, this is one strategy that we've utilized for quite a few this year. We do have clients in California and New York, and we're able to really implement it for them. All the laws have different rules, so you have to make sure that you're looking at that as well. I know that for California, for you to qualify for that strategy this year, you ought to have made a part payment of it this year. You ought to have paid about 50% or so in October. So if you miss that payment, you can't qualify for the strategy this year. States like Indiana, for instance, you don't have to make any payments. You can still elect to do this strategy while filing your taxes. Again, if you're working with a tax professional that doesn't know this, they will just file your taxes and boom, you're missing out on this strategy, on this tax savings. Worth looking into as well. Then retirement-based tax deferred strategies. This one is what everyone is used to, the 401k, traditional IRA. These ones are tax deferred. They are not, it's not like you're not going to save tax. You're not going to pay taxes. You're going to pay taxes on them, but in the future. It is not a permanent tax savings when you look at it, because depending on the strategy that you're picking, whether it's a traditional, whether it's a Roth, whether it's a 401k, if you are doing a Roth right now, you're going to pay taxes right now, and then in the future, your earnings and your contribution into Roth is not taxed, right? Traditional 401k or IRA is going to save you taxes now. You're deferring your taxes into the future. If you take money out now or prematurely, you're going to pay 10% penalty in addition to the taxes. But if you wait till the retirement age of 59 and a half, you get to pay taxes that year. So you get to pay taxes in the future versus paying taxes now. So these ones are tax deferred. They are not a permanent tax savings when you look at it. And for business owners, solo 401k, I actually have to mention this, because if you find yourself in a situation where you are faced with a huge tax bill right now, and you know that you don't have the cash flow, you just don't want to pay this money, you prefer to just defer it, right? Solo 401k is for those business owners with no employees, just a single owner. You can defer about up to this amount, and then SEP IRAs as well. But these ones have very specific income limitation. So you really have to be working with someone to help you, whether you're a financial planner, to help you determine how much you can contribute. You can discuss with your financial planner, you can discuss with your CPA as well on this ones. So I'm almost done. Strategies to take advantage before the year end. So today is December 9. What are the things you can still do before that can still move the needle for you before the end of the year? If you are a real estate investor, if you've had properties that you put in service last year, and you know that you've spoken with your accountant, and you know that you're going to benefit from cost segregation, you can still do a cost seg this year to take advantage of properties that were placed in service last year. You can still do a cost seg for properties this year as well. So the cost segregation doesn't have to be completed by December 31st. You can still do a cost seg. Oil and gas investments. The two funds that I know that are still accepting oil and gas investors, they are still available right now. If you want to invest in oil and gas, you can still do so before the end of the year, December 31st. So that's still open. S-Corp election. If you know that your business this year, if you know that you made close to $100,000 or more in net profits, and you are still a single member LLC, or you are a multi-member LLC or partnership, have you explored an S-Corp election? You can still do an S-Corp election for 2023. Though it is late, but we've been able to help our clients get S-Corp election approved even for 2 years prior years. So you can still get that election for 2023 to save you about 15.3% in taxes on self-employment taxes. Most of the tax deferred strategies are still available. You can still put money in, max out your 401k, do your company match, and then also you can contribute to HSA. HSA account, I really like it because that's the only account that I know that you won't pay taxes on. You're putting in money pre-tax and you're taking money out for medical expenses without paying taxes. And the good thing with HSA is that you can also invest it invest the funds. So you don't have to put it there and let the money sit there. You can invest the funds in stock market and whatever. So again, a very good strategy there. If you work from home fully, are you taking the home office deduction? That's also a deduction that is available for those that work from home. It might not be a lot, but it's still going to add up something to reduce your tax liability. Are you using your car for business? Are you keeping your mileage? If you real estate, I know realtors and real estate investors, you guys drive a lot. How are you tracking your mileage? You may be missing out on a lot of deductions by not doing that as well. Then donation, you can still do that for this year. I mentioned that. And then also for those that are cash-based businesses, if you are a cash-based business, now is the time that you don't want to start looking for, if you know that you don't want to increase your tax bill for this year, could you delay your cash to your receipts from your customers? If someone is going to pay you, say on December 25, maybe you rather just delay the payment and let them pay you on January 1st. Again, for cash-based businesses. Or do you have a bill that typically you can pay this bill maybe next year, January? Could you reach out to that vendor and tell them you want to pay their bill in December so that you are putting in expenses that would reduce your taxable income? Again, that's another strategy that you can implement. That's just more like you're planning timing your expenses for cash-based businesses. There are a lot of other strategies, but the time is so limited, I really cannot cover everything. Then for 2024 and beyond, are you thinking of selling your property? If you are thinking of selling a property, whether next year, 2 years, 3 years from now, consider doing a 1031 exchange before you sell it. But even before you do a 1031 exchange, you also have to let someone, a CPA or whoever you're working with, to simulate the capital gains that's going to come up on that sale. If your capital gains is not going to be significant enough, 1031 exchange might not even be a good strategy, right? So you really have to understand that for you to do that one exchange, it's really important for you to analyze how much exposure, how much capital gains am I even looking at? If I sell this property now today, how much is the tax I'm going to pay on it? If that tax exposure is not huge, it's not significant, you might not even want to go through the hassle and the stress of 1031 exchange. But if it's significant and you know that you can still invest, you want to use it to buy another property, consider doing a 1031 exchange. Do that at back of your mind before you even start putting or selling the property. The another thing is for those that have residential homes, if you want to sell your home, consider the 121 exclusion, which is if you sell your residential property where you live, if you sell it, you can exclude up to $250,000 in the capital gains tax exclusion. And then if you are married filing jointly, you have up to $500,000 that you can exclude. Now, the tax planning opportunity here is that if you've lived in a house, and usually the rule here is that you have to have lived in that house for at least 2 years in 5 years. I believe you have to have owned that house for 5 years and lived in it within 2 years. So if you know that you are selling a property and you've not met that threshold in terms of the number of years you've lived in that property, could you delay that sale for a year so that you can meet up with that threshold so you can qualify for this? I once had a case where a client came to us and they sold their property, and it was just about 3 months for them to have qualified for this exclusion. But they sold the property and they didn't qualify because they sold their property prematurely, and that threw them out of that exclusion window. So again, think about that. If you ever think of selling your house, have you lived in that house for that window of years that you can qualify for this exclusion? That's another thing to consider. Then, if you have a business, are you considering selling your business anytime soon? One thing you have to know is that for C Corps that have qualified small business stocks, you can exclude your capital gains tax. So your capital gains can be excluded from taxes. This is a very important strategy for physicians and even high income earners that have businesses that they want to sell. If you want to sell your business, can you please do more research on this? If you could convert your business to a C Corp, And then there's also a window by which you have to wait before you can sell. But look at this strategy and see how much capital gains you're going to get, and then see if you can qualify for the exclusion. Because what this does is that if you qualify, the capital gain on that business sale is tax excluded. You don't pay capital gains on it. And that's huge, really huge. Significant tax planning strategy here for you there. Another thing is, a lot of you may, because of the interest rates is high and all that, people are now sitting on cash. Like people are sitting on cash, sitting in the checking account. Have you considered putting your cash in high interest yielding accounts? Some banks are actually giving about up to 5% in interest. So if you have any cash that is sitting down it's just in your interest account, your checking account, consider putting them in high interest yielding accounts. So at least you can get some interest there. This is not really a tax savings strategy, but it's just something to think about. And then for those that are really donation inclined, you really like, if you ever thought of, okay, you have it aside from your work, you want to give back to the community, you want to give back to the less privileged, you want to impact, you could also set up a private foundation. Private foundation are similar to, not similar, but they're similar to that. But the difference is that for private foundation, you are solely responsible for the compliance, operations, and all that. But it's a very good strategy if you are highly charitable and you really want to be able to determine where your money goes. You really want to have control over your donation. Private foundations are very good, and it does have its compliance and operations requirement as well. And so this is also something you can speak with your accountant or CPA with as well. And the last one is maximize deductions on travels, timing of expenses, and all of that. So these are some of the things that you can think of for 2024 and beyond. You can see that some of them are things that are not even, you might not be thinking of them now. Maybe next year you may be thinking of selling your house, or next year you may be thinking of selling your business. Could you wait and just research more into this so you can see how that can save you on capital gains as well? And then this one is really important that I mentioned that in as much as we're trying to save on taxes, we're trying to avoid paying taxes. The foundation of everything actually starts with record keeping. How accurate are your records? Because when you think about the impact that errors can make on your books and on your taxes, you realize that you rather invest in a bookkeeper or a professional than risk overpaying in taxes. Right? One of the errors that not having a good record keeping system will do for you is that you're going to be missing on deductions. I've seen it several times where deductions. I recently shared a post on LinkedIn, the one I said I saved a guy, the tax letter and all of that. One thing I realized when I did that amendment was that there was a very huge deduction that was excluded. And so he overpaid on that. IRS picked it up and they sent him a letter. When I looked at his tax return, I realized that, number one, there was an omission of income. And even more importantly, his 1099, there was no expenses that were used to offset his 1099 income. So IRS taxed his 1099 income 100%. Right? How were we able to help him save on resolve that? I looked at his 1099 and I was like, you have expenses that you can use to offset this thing. There's no way they will tax you on 100% of this income. Let's go look for your deductions. We were able to get deductions to help reduce that taxable income to a significant amount of money that by the time we amended that tax return, IRS has accepted our amendment and they adjusted his amount due. We were able to save him about $6,000. So again, that's the impact of record keeping. So definitely make sure that you're doing that well. Also, a lot of people commingle. This is very common. If you have an LLC, you don't commingle, the impact of that is you're exposing your business to liabilities, and also you also run the risk of missing out on deductions. And I'll explain that. If you use your personal account for expenses, I've realized that during tax period, oftentimes taxpayers forget that, hey, I paid for something with my personal account. So what I tell people is that if you have a business, have a personal business account. plus a business credit card. A business credit card and a business account. Sorry, I take that back. So a business account, checking account, and a business credit card. Because if you have a credit card, in instances that you don't have cash to pay for your expenses, you can swipe your credit card for that. And whoever is doing your bookkeeping will be requesting your business credit card and your business banking checking account. So that way, there isn't any business account going to your personal, and you don't miss out on deductions. To avoid using your personal account for business expenses, if you don't have a business credit card, please go and get one. I don't like using credit card as well. I don't like keeping balances on it. And I know that some of you may have that same issue, but you can always pay off your credit card at the end of every month. So you don't accrue interest on that. But the essence is it avoids you from commingling and using personal accounts for business expenses. Then also, if you don't have good record keeping, audits if you're audited, you run the risk of losing out on all your deductions. A case that I can really explain here was a client came to me. I didn't prepare his tax return. So he came to me and he was audited. He was audited for a prior year. So he came to me and said, Taiwo, I want to amend my 2022 tax return. I know they're going to audit it. So I said, okay, no problem. When I looked at all of this, I said, okay, this deduction, do you have documentation? He said yes. Do you have documentation? He said yes. Do you have documentation? He said yes. Lo and behold, after they have amended, they audited the first year. They audited is 2020, I believe. So I did 2021. And I was asking him, do you have documentation? He said yes. I prepared all the taxes and all that. I submitted it. About a couple of months after, he came back to me and said, they are auditing 2020, the year that I prepared his taxes. And I told him and I said, and so they were also asking for specific line items. And I said, remember this one? I asked you, do you have documentation? You said yes. Okay. So you said you had documentation. So send the documentation to them. I told you, I asked you for documentation for this one. You said yes, you had documentation. So you have to send it. So at the end of the day, I was able to absorb myself because those questions were asked for each of those deductions. I was asking him, as long as you have documentation for them, we can take the deduction. And then when he was audited, that was the word that I used for him. And I told him to send those documentation to the tax, whatever. I didn't get involved in it because he didn't pay me to represent him in the audit. He handled it. I don't know how he handled it anyways. But the truth of the matter is that even as you're doing all of these strategies, documentation is your best friend. You still have to always keep your documentation just in case you're audited. And then for real estate professionals, if you're in real estate, how are you tracking your income and expenses? One thing I've realized for real estate investors is that they don't keep accurate books. Sorry to say, you guys are Excel folks. You guys just like using Excel. And it makes taxes quite difficult because now you're having to deal with where is this expense coming from? What is this expense for? You can save yourself and your tax preparer that headache by just invest in a small bookkeeping software that will help you track your assets, your properties by class. By class, that is, each property will have its own income and expenses, clean and clear. And then you're also able to track your basis, which is your cost and accumulated depreciation over time. So that's really important, particularly for real estate, is you have to understand that your cost, which is your basis, and your depreciation impact your capital gain significantly when you sell. So you want to make sure that your tax preparer is also tracking your depreciation and your basis appropriately in that asset. If they are not doing that, it becomes a problem when you sell that property because now you're going to be looking at a huge capital gain, right? And also the last one for limited partners and general partners in syndication deals, you also have to be keeping track of your K1s and your contracts. A lot of people are investing in syndication deals right now, either as an LP or GPs. You're going to get K1s. If you've invested in oil and gas, any of those strategies, and you have your K1s, those are very important documents that you also need to keep. The key here is just that record keeping is your best friend in an audit. So please, if you don't have the time to do it, outsource it. Save yourself the headache, outsource it. it's going to end up saving you more money than you think that you are saving at the end of the day. Then this last one is, you may have been saying this already, but this is the new reporting that is coming up in January of 2024. It is called the Beneficial Ownership Information Reporting. If you have an LLC, a partnership, an S corp, if you have an entity, whether it's a domestic entity or a foreign entity, you are obligated to report this information to FinCEN. A beneficial owner is an individual that controls about 25% or more of ownership interest in a reporting entity, and then also exercises substantial control over that reporting entity. I didn't want to make this go beyond too long, so I just captured it here. But you can definitely find more information. I did put a URL there for you. You can get more information there. Please, if you have an entity, please don't take this with levity. Please do your research and also bring it up with your tax professional before the end of the year or even by January. That's it. Sorry, I hope I did well on time. Oh my goodness.
Yeah, but it's a very important topic. Thank you very much, Taiwo. And I really learned a lot, because one of the reasons why most of us go into real estate, real assets, because oil and gas is real assets business. That's a category that we actually deal with. The main purpose was because of the tax. We want to make sure that it's less effort for you to save in taxes versus working more hours to make more money. So to make extra 100,000 might require you to work extra Saturdays of every Saturday of the year, right? To pick a locum. Whereas saving 100,000 in taxes might be much easier than that. So I focus my time. Now I'm not even focused on making more income at this point. I'm focusing on decreasing tax liability, get my tax to zero, and then as low as possible. And then, of course, you start making higher income again. But so yeah, those are very great topics that you mentioned. You guys feel free to exit if you want to, but we have a few questions and we can answer it. It's going to be recorded. So we're going to have the answers to all the questions. So some of them I answer in the text. Someone said, you are saying that you don't qualify for rep. If you don't qualify for reps, you cannot deduct your losses from your real estate from your W-2, but you can do it from your real estate income.
Okay, so that question is, if you don't qualify as a rep, you cannot deduct your losses from your real estate from your W-2, but can you repeat this last one? Sorry.
He said, but you can do it from other real estate income.
Oh, okay, yes. If you don't qualify as a rep and you have real estate income, your real estate income is also a passive income. So you can offset your passive income from passive loss. So that means that if you don't qualify for real estate and you have losses from your real estate investment A and you have income from real estate investment B, you can offset each other because they are both passive income. Does that answer the question? I hope it does.
Yeah, so I'm doing this. Another question, does depreciation recapture still affect a 1031 exchange?
So 1031 exchange, depreciation doesn't come into play in that. And that's because, not like it doesn't come at all, but that's because recapture happens when it usually happens when you're selling completely. So when you're selling completely and you're not doing recapture. So when you do a 1031 exchange, as long as none of that money gets to you, you are completely defining that capital gains to the next property. So now your depreciation recapture doesn't, you don't pay taxes on depreciation recapture when you do a 1031 exchange. You continue to extend or postpone the capital gains. So you don't pay taxes when you do you don't pay taxes on the capital on the recapture when you do the 1031 exchange. I hope I'm trying to understand the question well.
Yes.
So I think what he's saying is that when you do a 1031 exchange, do you pay taxes on the recapture of the depreciation? The answer is no. As long as you have an intermediary that has done it well, and there's no boot. We call it boot. Boot is like none of that money gets to you in any way. You completely use all of that money to replace another property. You are not going to pay taxes on that. So it doesn't, recapture doesn't come into play there, and you don't pay taxes on the recapture.
Yeah, I'm not a tax professional, but we've done 1031 exchange as real estate syndicators. Yes, basically you can 1031 exchange till death. Okay, yeah. You can just, as long as the Congress doesn't change the law. So you can just keep on doing that and just avoid the taxes. And then you get the step up. There's a different strategy when you finally give it to your children. So it's another one. When you give it to your kid, then you can actually just keep the tax. So you get the step-up basis. Is that correct? So when you give the house, the property to your kid, you 1031 exchange from the beginning all the way to the end, and give it to your kid. What happens?
So when you give the property to your children and you wait until the time of death, you get a step-up basis. So what that means is that if you purchase the property for $100,000, and at the time of death, you transfer that property to your children, to your offspring at the day of death. The step-up basis means that the property will not be valued at the market value, lower of market value or adjusted basis in that property. But the impact of the step-up basis is that now your capital gains will be reduced. So you can imagine if you purchase the property, you took over a property that was purchased for $100,000, and now that property worth $600,000. That means you'll be exposed to about, after all expenses, you might be exposed to about capital gains of $500,000 left, right? But if you have a step-up basis, because of the fact that the property has appreciated over time, that $100,000 property might be worth maybe $400,000 now. So instead of you having $500,000 in capital gain, you may just have about $200 to $50,000. So that's a very good tax planning strategy where people have said, if you know you have a property, instead of gifting those properties to your children before death, some of the estate planning strategies that just don't gift it to them before death, gift it to them at the time of death or maybe after death, so that they get a step-up basis. Because if you give it to them when you're alive, they are going to, the basis on that property is the market value, the adjusted basis of the owner. So you're not going to be saving so much taxes when you give it to them when you're alive. So it's always better to wait till maybe you write it in your will or your trust or whatever, that the asset transfers to them after death.
Yeah.
Does that make sense?
Yeah. Okay. So that's, I also learned something. So you don't completely, my goal was trying to eliminate it. Continue 1031 exchange all the way, right? So let's say you start with $1 million and somehow you did all these things. And by the time you exchange like 10 times, over 30 years, so now you have $20 million.
And you don't completely, no. So even if you do 1031 exchange indefinitely, you still get to that point where the asset will still have to sell, or maybe you transfer it. So at that point, when you transfer it to your children, they're going to get a step-up basis at that point. So is either your estate is paying the taxes or your children is paying the taxes. Of course, that has to go through, after that, it's going to go through estate planning and all of those things. But again, it's not like you're not going to pay taxes at all. If you're not paying it alive, your option will pay it if they're taking over that property. It's just that the capital gain that they are going to be exposed to is dependent upon whether you're giving it to them at the point after death or you're giving it to them before you die.
Okay. So after that it is. So yeah. What's the minimum period that you have to run the short-term rental for you to be able to write it off your taxes?
What do you mean? So if you, for short-term rental, as long as you put it in operation for that year, so let's say for 2023, you don't have to have run it for the whole year. It could be just 1 month. As long as you've placed it in service during that year, you can use the strategy. But again, you have to go through the conditions that I talked about.
Okay. And then
1 year, 3 months. Okay. Yeah, it doesn't have, if you can even put it on the market December 15, right? You still qualify for short-term rental as long as, again, it meets those conditions. right? Those conditions have to be met.
Okay, so you're saying, so I bought short-term rental January 1st, I sold it December 15th, but I met all the criteria. I can still use it, the depreciation.
Oh, okay. So it's a different thing when you buy it in the same year and you sell it in the same year. So when you're doing short-term rentals and you buy it and sell it in the same year, technically you're not going to be able to do cost education. So your depreciation will not be significant enough since you're not doing cost education. But you can still do short-term rental. If your intention, if you did it, use it for short-term rental and you qualify for short-term rental during that year, you can still use it to write up your taxes during that year. Okay, but those conditions still have to be met. But it's just that, again, your expenses, the write-off might not be significant enough because, again, you cannot do a cost seg for a property that you only held for 1 year.
Right. Okay. No real estate in S Corp, question mark. Okay. If one has a holding company that is an S Corp, it shouldn't hold the real estate that is set up as an LLC. Basically, is there any role for S Corp at all?
Okay, so that one is entity structuring. So you're talking about where the S Corp is the holding company, and then the real estate. So the real estate can be in the LLC. With what you just explained right now, there is no problem with that. As long as the real estate is within the LLC, not the S Corp. Does that make sense? So in this case, you can have an S Corp as an holding company, but it's just that the LLC, the S Corp cannot own the LLC. So you cannot own the property. And that's because for S Corps, when you have a real estate, you're not subjected to self-employment taxes. For real estate party, any real estate investment, because your taxes is prepared on Schedule E, so you don't pay self-employment taxes. Now, if you go put your property within an S Corp, you are going to be paying self-employment taxes. So in a way, you are even paying more taxes if you put your LLC under an S Corp. But so if you put your property in an S Corp, but you can structure it in a way that your S Corp is the holding company, but within the holding company, you have an LLC that owns the property. So that's it. You can do it that way. But what I said was that the S Corp itself cannot own the property. It's not a good strategy. You're going to be paying more taxes if you do that.
Okay. And then let me see what else. I think we have one more. Can you please describe how alternative minimum tax impacts all the W2 related strategies? Hold on. Strategies for both tax write-offs and tax credit. Can you simply be saving on tax with one hand and giving it away with the other hand?
That's a little bit confusing. AMT is a little bit advanced topic. That usually it's confusing. And for that question, I may have to just back with you on that one.
Okay, let me copy it.
Yeah,
I'll copy it and I'll send it to you.
Yes, please, just, yeah. It's a little bit advanced, and if I go into that, it's a little bit advanced. I don't know if it's not going to be confusing if I start talking on that right now. How much donation do you need to?
So there's one. Yeah, how much donation do you need to open private foundation?
Okay, to open a private foundation, the last time I checked, you don't have to have. So let me explain it. Let me explain it in a different way. So private foundation is that you are the only one. It's different from public charity, right? So private foundation is that you, just like Bill Gates Foundation, you're the only one funding the foundation. It could be, so I can see the question was asked by IFAI, it could be IFAI Foundation, and you are the only person funding that foundation, right? So I don't think that there isn't any minimum. The last time I checked, there isn't any minimum, but once you get to a certain amount but the minimum that you can put, I mentioned that you're limited by your AGI. So if you want to put money into your private foundation, you cannot put more than 30% of your AGI. That's the maximum. But there isn't any minimum. I don't think there's any minimum the last time I checked. But you also have to know that there are certain requirements that when you put money in a private foundation, you have to use certain percentage of it in a year for donation. So you can't just use it and donate there and just hold money in it. and not use it. There are specific guidelines as to the percentage of money you can put in that fund without using it. Let's say you put $100,000 there and you don't intend to use it for any donation. There's a rule that you're going to be breaking. I can't remember that rule now, but you have to also abide by that, because a lot of people understand the strategy. And so what they will do is that they will just move funds from their maybe their normal business and move it into their private foundation account. And that money is sitting there not doing anything. You'd have to use that money for a charitable cause based on what you've set up that you're going to be doing in a year. But there's no minimum.
Okay. So this is gonna be the last question, which is together. One is, do you help with foundation setup? And also, are you able to, if you have a private foundation that is set up in the US, can you give to outside of the US, charitable cause outside of the US?
Yes. So think of Bill Gates Foundation. Just think of Bill Gates Foundation. That's the only thing I can think of, because it's a similar scenario. So what those things are doing is that if you have those foundations, now you can donate to causes outside of the US that are within your, when you're setting up the foundation, you have to have a mission and whatever statements that are within your mission and mission statement. So I also get a lot of questions where people ask me, Taiwo, I give money to someone in Nigeria, or I give money to someone in India, can I take that as a deduction? The answer is no. And that's because you cannot give money to individuals and count that as a charitable donation. Charitable donation in the US is you are donating to a 501c organization. And for foundations, a lot of them are set up in a way that the money that you're donating to them, they can use it for causes. The likes of whether it's Red Cross, United Way, and all of those organizations, they are investing in and helping people in other countries. So definitely you can invest you can donate to other outside of the US, but that money has to go through your foundation. So you cannot just send money to someone in whatever country and say that's donation. It has to be through your foundation. And also, when you have a foundation, there are reporting requirements as well. There's a 990 form that you need to file, 990 PF for foundation. And so within that 990 is where you're going to be reporting the use of your fund. So you can donate to outside the US. And then in terms of whether we do help, so in terms of private foundation, yes, we've assisted a few people to open a private foundation. We don't draft the operating agreement, but we've done a couple this year for private foundation. But we don't draft the operating agreement.
Okay. So before you go, somebody also asked, I think I'm going to send that to you also. If you're using our private group, so you can also answer this group in our Dr. Bedeze investment group. If you're not on it, you can send us an email if you want to be on our group. And so something about why do you do private foundation over donor advised funds? But we're running out of time.
Okay. So that's a good question. So donor advised fund, you're putting the money under Fidelity. So those funds are opened by brokerage firms, and it doesn't give you the 100% control that you want versus when you have your private foundation. So if you want your foundation to be something that you want to control, be in control and everything, private foundation is better because you can control all of that. But donor advised fund is that money is going to Fidelity, and they are going to you're going to be telling them where they will donate the funds to. So you don't have complete control over that. Another thing with donor advised fund that I like is that donor advised fund they also invest it in the stock market. And we did set up one for a client last year. And this year, when we were doing a tax planning, she was complaining, Taiwo, I don't know what's happening to my DAF. I don't know what's happening to my DAF. And when she looked at it, they had invested that fund. That fund had grown significantly from what she donated the prior year. So that kind of gave her some peace of mind. Okay, my money is still there, even though she has not donated it. So that's one thing with DAF. They continue to invest the fund. But it's also another thing I like about DAF is that it saves you the headache of compliance and reporting. So compliance and reporting are things that if you have a private foundation, you have to be dealing with. Of course, you have to work with a CPA or whoever to handle that compliance, reporting, and all of those stuff. But with that, you don't have to think about that. Everything is handled by those guys, brokerage firms.
Okay, I think we're gonna end there. Man, I gotta say, you have such a great holding power. There's still 24 people left after 1.5 hours. So that shows.
I'm so sorry I went above time.
No, it's just what a great, you have such a mastery on the topic, right? And also you're very good at presentation, right? So one last thing, can you tell people where to find you? I have posted your LinkedIn page for people to find you on LinkedIn. She's very responsive, but you can also tell us where to find you.
Okay, so I'm on LinkedIn. I'm very active on LinkedIn. I'm also very active on Facebook and Instagram. But if you do want to contact me, this is my contact information. This is my contact information. For anyone within Dr. Bayo's group or Dr. Ozoude's group, you can find my number on the WhatsApp group. I believe I'm a part of that community. We can find my number there. And this is also my direct email address. But you can follow me on social media as well. I'm on LinkedIn. I do post on LinkedIn pretty frequently and on other social media platforms as well.
Okay. Perfect. Thank you, Taiwo. I really appreciate it. And you've been very pivotal in our community. She answers all the tax questions pro bono. I really feel like we should be paying you. I mean, you do get clients, but still, you answer a lot of questions online and also in our group. So we really appreciate that. So, well, thank you for coming. And thanks, everyone. Enjoy your weekend.
All right. Bye-bye.
Bye.